Hey, everybody. Good morning. Good morning. It's going to be a great Sunday. Happy Sunday to all. We will get started in just a moment here. A little intro video, and then we'll start.
Joining us now is a guy who knows real estate from the bottom up. Investor, made millions of dollars understanding market trends. I want to tackle two things with you, Jason. First is there a looming crisis? Number two, what will be the big trend that comes out of this?
Rick, great question. It's good to be here. The question when it comes to real estate is what type of real estate and where. There are three basic types of real estate markets in the entire world: linear, cyclical, and hybrid markets. The cyclical markets, meaning the expensive markets around the country, South Florida, the West Coast of the United States, the expensive northeastern markets, they are in for trouble, especially if they are high density markets.
Well, this is my very first Jason Hartman conference. I've been listening to his podcasts and I have been learning a lot there, but already in the past couple hours, I've learned about what more to look for on pro formas. I've already learned quite a bit that I didn't know. And I'm looking forward to learning so much more the rest of this conference so that I can make better investments and make better choices in my investments.
Hi, I'm Jason Hartman, and I want to talk to you about some of the core teachings that have been very popular that I've been talking to the marketplace about for the past 14 years or so. My first set of core content is called the 10 Commandments of Successful Investing. And I created these so that there could be a core outline that you could really quantify and understand. If you understand these 10 commandments as an investor, you will do pretty well. It's not everything, but it's certainly a very, very good foundation. Then several years later, about 10 years ago, I did a second 10 commandments. So there were 20 at that time. And let's talk about one or two of them today for just a few moments. The first one sounds obvious, but let's unpack it a little bit. It is, thou shalt become educated. Thou shalt become educated. You know, education is obviously important. Nobody would deny that. But here's the thing. Education needs to be, number one, it needs to be practical and it needs to be actionable. Number two, it should be either very inexpensive or free. It's an amazing time to be alive, as I always say. And in the world today, information is plentiful and it's usually free. You know, there's an old saying, information wants to be free. Maybe you've heard that. And when it comes to learning how to be a good investor, you do not have to pay someone a fortune to buy their course or get their coaching program. Maybe you pay a little modest amount for good education of someone you already follow and know and like their teachings, and that's fine. But don't pay a lot. So again, practical and actionable, and free or cheap, one or the other. The second of the 10 commandments I want to talk about today is thou shalt have a team, a professional team. Now, you've probably heard people say this or suggest this in one form or another, and certainly having a team of people to help you do anything is beneficial in life, no question about it. But you want to have a team that is actually doing it. I remember one time I was being pitched for about an hour and 15 minutes or so on some guru's coaching program, and this was kind of funny. I asked him during the call. I said, you know, are you a real estate investor? He was pitching a real estate investing program, and I said, are you a real estate investor? You know, how many properties do you own? How much experience do you have? And he, as my potential coach, says to me, hey, look, you know, Tiger Woods has a coach and he's the world's best golfer. But here's the difference. And I replied with this. I said, look, I agree with you. Everybody needs a coach, even Tiger Woods. But the difference is Tiger Woods' coach has actually played golf. That's a big difference, right? So the person that is mentoring you or coaching you, or the person you're following and consuming their intellectual property, their content, should have actually played the game, right? Played the game.
All right, good morning, everybody. I hope everybody can hear me okay. Actually, I should plug in my headset. I know you can hear me already, but we'll make it a little better. All right, so I want to welcome our guest today, my good friend Patrick Donahoe with Paradigm Life and the author of Heads They Win, Tails You Lose. Is that the exact correct title, Patrick?
Heads I win, tails you lose.
Yeah. Great book title. And it's good to see you. How are you doing?
I'm great, Jason. I'm excited to be on with you.
It's good to have you. And that video we just showed was filmed at the studio at your office about 3 years ago. Remember that?
I recognize the background and the microphone. Yeah.
I thought you would. Well, hey, it's good to have you on, Patrick. And we're going to dive into some good topics today. And we've already got some comments and questions coming in, so keep them coming. We'll try to be here for last time we went like 2 hours almost, which is a little bit long, folks. And Patrick, feel free to bug out anytime. We totally appreciate you coming down. You don't have to stay for the whole thing, but I'd like to wrap it up in just over an hour today. So the way you viewers and listeners can help us with that is you can post your questions early, so we can kind of get to those as soon as possible, and really jump in and kind of front load the discussion with some of those questions for you as early as possible. So what are we going to do today? Well, I've got Patrick's book up there. There we go. Heads I Win, Tails You Lose. Great book. And Patrick, we appreciate you joining us. The tax-deductible dog is somewhere around the house. I don't know where she is, but I hope everybody likes that. You want to deduct your pets, use them in your business. Put them to work. It's kind of like putting your kids to work.
Your kids too.
Yeah, absolutely. Pay your kids a salary instead of an allowance. The salary for doing a job can be deductible. And, speaking of taxes, we've got to all realize, and I want to just remind everybody of this again, the single largest expense in anybody's life is taxes, some form of tax. And if you are in places like my former home, the Socialist Republic of California, or the Socialist Republic of New York, or the Socialist Republic of Connecticut, or any of these other left-leaning places, you know how significant taxes are. And Patrick, what amazes me about the subject of taxes and taxation in general is that people will spend so much time shopping for a new computer, a new TV, a vacation. Well, nobody's shopping for a vacation now, unfortunately, but a new car. A lot of people are buying RVs and motorhomes right now, so maybe they're shopping for that. They'll spend a lot of time shopping around, researching the topic, getting to know who the players are, who the best dealerships are, who the best the best outlets to buy the product, right? But they spend no time learning about taxation. And that is the largest expense. So if you want to spend your time where it's the most profitable, investing and growing your wealth, that's kind of obvious. That's what we do. We help people with that. But also learning to save on the largest expense in your life, taxation. So we're gonna talk about that a bit today as well. So Patrick, it's good to have you. Let's talk a little bit about some news items and some things going on in the world. And there is a lot going on in the world. I think just several months ago, we all thought the world was coming to an end. Now that view is changing pretty dramatically. A lot of people feel like they've been had with all these shutdowns, lockdowns, quarantines around the world. Many people, really credible people, are starting to feel like this is just a big scam. the pandemic, COVID 1984, right? To bring it into George Orwell and the Orwellian idea of where governments are using this as an excuse to monitor and intrude on our lives and limit our speech. A friend of mine yesterday, actually, we know Patrick, a mutual friend. He has a big podcast, big audience. He told me that he tried to post a video about hydrochloroquine, and YouTube, knocked it down. They wouldn't let him have it. Hydroxychloroquine. I don't know what's the name of it. Hydroxychloroquine. Sorry, misspoke. It's early, folks. I need more coffee. and there's just all this censorship going on all over the place, and I mean, they've got their reasons, right? There's a lot of quacks out there, a lot of people promoting ridiculous stuff, of course. So it's a hard line, and nobody knows exactly where to go or how to deal with this stuff. But whatever the case, many parts of the economy are booming. This is a very, very uneven situation, probably more uneven than any prior recession or depression. For some, it really is a depression. And some people, their business is just booming. The digital workers, the information workers who can work remotely, they're doing pretty well. And we'll get to a chart in a moment about this, but they're saving a lot of money too. So first off, let's look at mortgage rates. Okay, conventional mortgage rates over the past 30 years, they have plummeted, and it's fake. It's fake news. These rates are fake. They are understated. They are way below where they should be to have a legitimate situation. But again, the Fed and the government and other governments and other central banks around the world have artificially suppressed mortgage rates and interest. Well, they don't directly control mortgage rates. The Fed doesn't, at least. Other central banks might. But our Fed influences mortgage rates, doesn't directly control it, but they do control other rates. And so we're in a situation where we have ridiculously unsustainable rates. It's just absolutely crazy. Here's something interesting too. When we look at the money supply, the supply of money is measured in all kinds of ways. And one thing that just totally bugs me is that back in, I believe it was 2006, and I reported a lot on this at the time, haven't thought much about it lately. And that's what they, the powers that be want us to do. We kind of just forget stuff. It goes to the sidelines. Do you remember, folks, several years ago, the outrage, the concerns that everybody was having, all these conversations centered around something nobody even talks about anymore? The NSA and their monitoring of communications, and all in the guise of keeping us safe. It's always for our protection, right? And some of it legitimately is, no question about that. But in the guise of keeping us safe from terror, right? Terrorism. And so they built this giant data center right near where you live, right, Patrick?
In Utah, yep.
Yeah, you're in Salt Lake City. Have you seen that complex? It's amazing.
Yeah, the majority of it's underground, but it's a massive, massive complex.
Yeah. So they're monitoring everything, and one of the conveniences, I guess, for all of us is you no longer need to back up your computer, because if your hard drive crashes, just get the backup from the NSA, right? Hopefully that's a joke. Hopefully it's a joke. But yeah, crazy. So one of the things about money supply, back to the chart on the screen, is that back in, I think it was 2006, they stopped publishing one way to account for money supply. It was called M3. And they didn't want us to know. I mean, they've got their own reasons, but in my opinion, and many economists' opinion, they didn't want us to know how much money was being pumped in the system. And when money is pumped in the system, that creates inflationary pressure. Remember, the classic definition of inflation is a large supply of currency units, in this case dollars, chasing a limited supply of goods and services. If you have a lot of currency chasing a limited supply of goods and services, what's going to happen? Naturally, you'll have inflation. Just like if you're at an auction and there's a lot of bidders holding up their paddle, bidding on the car or the artwork or whatever's being auctioned off, the price is going to rise, right? And this happens in the marketplace. That's how inflation occurs. So I just thought this chart was interesting. And this is a Federal Reserve chart. And it just shows the Consumer Price Index, the CPI, and that's the most widely used measure of inflation. Now, it has been massively manipulated and understated over the years. Three basic ways they hide inflation. They manipulate the index to make it seem lower than it really is. One is by weighting. In other words, it's a basket of goods and they give a certain amount of weight to each item in that basket of goods, right? So if they weight, widget A heavier than widget B, then that influences the price index of the overall basket of goods in the CPI or Consumer Price Index. And remember, there are multiple CPIs. This is the CPI-U, okay, the most widely used one, and it's for urban consumers, okay? There are other CPIs if you want to really drill down on this. And then they have something called the core rate of inflation. You might hear some talking head on CNBC or whatever sometimes saying, core inflation is down or up or whatever. And the core rate is where they strip out the cost of food and energy. Now, Patrick, I don't know about anybody else out there, but I know for you and me and your family, you can't live without food and energy, can you?
No, like you said, it's one of those things where, and Jerome Powell spoke on Friday. I don't know if you listened to his comments. It was brief.
Uncle Jerome, yes.
Yeah. But he basically created this understanding that there is an open-ended way in which they're going to measure inflation. And they were using the PCE for a really long time, the personal consumption expenditure. It's one of those. There's so many different. You have the producer price index. You have ways in which you measure prices across the board. And obviously, their charge is to create growth, right? To create, a growing economy, 2-3%. But now they've kind of left it open-ended as far as how they're going to measure that, which is interesting.
Yeah, good stuff. Yeah, no, it's the Fed last week was a titanic shift, or tectonic. Maybe that's a better word, not Titanic. I was watching a video about the Titanic.
The Titanic too. Maybe the tectonic will lead to the Titanic.
Did you know the Titanic had a twin ship? I didn't know that until just when I was watching this video. YouTube is a very educational thing. Anyway, this tectonic shift, basically our rich uncle Jerome Powell, Federal Reserve chairman, said, among other things, like Patrick was talking about, that they are no longer going to act in change Fed policy based on a forecast of inflation. They're basically now going to wait until it happens in order to adjust. And let me tell you why that is a giant, monumental change. Here's why. Look at the economy as the largest, most gigantic, maybe container ship or oil tanker. I don't know the biggest ship in the world. Probably will look that up right after this. Way bigger than the Titanic, though. It takes a long time to maneuver a giant ship like that, right? They've got to look out onto the horizon and look for obstacles or storms or things way ahead of where the ship is. Maybe the ship's only going along at 20 knots. But because it's so large, it needs to plan long in advance. Okay, we're going to come about. We're going to make a turn now. So if something is miles in the distance, they need to act way ahead of time because that ship is so big that it's a monumental event to turn it, right? And that's how the economy is. And so the Fed now saying they're not going to use a forecast to make their policy decision anymore. they're going to wait until it arrives, it could be way too late by that time. Patrick, any thoughts on that?
I have a lot of thoughts. I think everything you've been talking about, Jason, whether it's our current topic, inflation and monetary policy, but also goes to some of your initial comments on taxation. I think that we have biases I think it boils down to this. I think we have biases as kind of a population, right? We're kind of driven to conserve energy, and so we've accepted certain ways of living, including taxation and the government and monetary policy, where it's kind of like that's being taken care of. I don't have to worry about that. Therefore, I'm going to focus on my life and focus on what I can control. And I think education is the key. And I love how your intro video talked about practical and actionable education, because there's people that have a lot of education that don't do anything. Right? They just have it. They have more information, but it doesn't really make any difference as far as their life is concerned.
Right.
When you start to understand these principles, right, and what's going on in society, what's going on in the economy, it's not that you can control or influence it, because you can't, but you can operate in it. And if you know that information, it's going to allow you to make better investment decisions, personal decisions. And, and I look at that being the definition or the epitome of critical thinking. I think we're conditioned, right, in our school system to not think, right? We're conditioned to follow.
Which is by design, I would argue.
Yeah.
Right?
And these are things that we're not taught. Nobody's taught about tax strategy and taxation. I taught my kids through this whole quarantine. I said, okay, here's the average salary coming out of school, and here are all the taxes that are taken out. And, you can go on YouTube and there's tons of videos that show, kids getting their first paycheck, right? Teenagers. And they're like visibly emotional, upset, because they're like, I thought I was earning this and this is all that I get. Like who's FICA?
Yeah.
Who's that guy? Who's
right
from that? Right. And it's one of those things where, I think the experience of what's happening is allowing people in mass to ask better questions. But at the same time, I think the majority are just reacting emotionally, and it's not productive. It's not constructive, and it's leading to more harm than good, and more, I would say more intervention, more government, more central planning, unfortunately. But I look at, you doing this, people writing books, and hopefully this is leading to a segment of the population, an influential segment of the population that's waking up to what reality is. And I don't think Jerome Powell is like sitting up at night, thinking, hey, how can I screw the world? How can I screw the economy? I don't think politicians do the same thing. It's what they know, and it's what they've been charged with doing. And that's where it's like, sometimes you just need multiple opinions and a bigger opinion to combat the popular opinion. And hopefully that will start to move things along in the right direction, where there's more freedom and less control, less central control.
Yeah. Central planning and central control is never good for liberty. No question about that.
Or growth, or prosperity, or innovation, or a better life.
Good points. Well taken. Absolutely well taken. So, hey, viewers, please give us a like. And we got a bunch of questions and comments here. We love them. We'll get to those in just a moment. So we will get right to that. But please give us a like and a thumbs up, and post your questions and comments. So as far as the manipulation of inflation, right? So you can see here, consumer price index, this line, and you see how over the years, of course, that has gone up. The gray lines are recessionary periods, but still, even through those, you had some inflation. Here you had a little deflation in the Great Recession, the worst economy in 7-8 decades, right? But keeps going up. Now, look at the relationship between that and the money supply, right? So Milton Friedman, the late great economist, who was phenomenal. I had his grandson on my show, Patrick Friedman, and then I had his son on my show as well. So Milton Friedman made the famous saying. He said that inflation is always and everywhere a monetary phenomenon. Now, economists disagree with him, and what he means by the monetary phenomenon. Remember the two basic policies that influence the economy: monetary policy and fiscal policy. Monetary policy is what the central bank does. In other words, that's Jerome Powell, that's the Federal Reserve, it's other central banks around the world. That's monetary policy. Fiscal policy is what the government does, the way they tax, the way they spend. And mostly this is determined by the House Ways and Means Committee. But it's also determined by, you know, the rest of government, including the president, of course. So here, remember, we were talking about those three ways that this index is artificially suppressed. We talked about weighting. The other way is substitution. So substitution, basically that basket of goods in the consumer price index, they say, okay, well, if the cost of beef went up, everybody will just eat chicken instead. And, you know, maybe you don't like chicken. Maybe you think chicken's a dirty bird and you don't want to eat chicken, right? But they will just assume there was no inflation because they're going to make a substitution, right? And then the third way is called hedonics. And that's the root word is hedonism. What does hedonism mean? We all know that's seeking pleasure, right? And so they index the cost of something by the amount of pleasure we get out of the item. So technology wonderfully advances all the time. Everything just keeps getting better and better, right? You know, this iPhone is much better than my first cell phone, which weighed 14 pounds and cost $3,200. And I remember when they upgraded the iPhone and this came out and everybody was complaining, oh my gosh, this is $1,500. Well, I wasn't complaining. I thought it was a great deal, you know, but hedonically indexing, they would take the cost of a prior product. And if the processing power of that chip and that computer doubled, they would only assume that you paid half the price for it in hedonic indexing terms. But that's not fair. Why isn't it fair? I mean, it seems logical on the surface to index like that. But what it's saying is that you as the consumer, you are not entitled to progress. Only the consumer price index is entitled to progress. You, and I say that's wrong. You have the right to expect things to get better and better. Okay,
and cheaper,
and better, cheaper, yeah, whatever. Right? It's really a function of the same thing. Better and cheaper are kind of the same thing. You know, it either gets better or cheaper. Hopefully both. Right? Hopefully both. This is just you know, one of many articles, and feel free to chime in on this stuff. We haven't really talked about it, but you know, this article is saying, and by the way, I just want to state before I get a ton of arguments here that I don't have like a huge opinion about this stuff. I usually have a huge opinion about everything. This one, you know, I haven't researched it to death, and I don't know. But you know, there are some that say, well, this whole thing, it's just the flu, and others will say it's really serious. And you know, I don't know. Maybe Patrick has a big opinion about it. I don't. But the news is getting interesting because this one is saying that last week the CDC quietly updated its COVID-19 numbers and basically said that the comorbidity was the you know, by far and away the massive amount in the death toll. And when you really look at it, the number was only 9,200 people from actual COVID rather than a motorcycle accident, but having COVID coincidentally also, right? And you know, all these people in the risk groups, they were already very elderly or already very obese or whatever it was, right? Having all these other risk factors. So, you know, but they label, it's how they label the death, right? So, you know, feel free to chime in about that one. I think we could go forever on that.
I would say this, Jason, and this is not necessarily an opinion toward, you know, what's going on with quarantine and COVID. And just like you, I'm not an expert in that field. But what I find interesting is it becomes very difficult for people to be open to multiple opinions, to multiple perspectives. And what that does is, I would say it detracts from really what capitalism is and what information people need in order to make the right decision, right? And that's where it's really interesting. Where, again, going back to my original point, I think because our inability to critically think, right? We associate a different perspective with a group or association that we have. And what it does is it kind of blinds us to other perspectives and other ways of looking at things because of the fear of being wrong, right? Or the fear of a group being wrong, so it goes down this very emotional trail. And so that's where it's like all perspectives, I think, are valid. Either they, back something up or they are invalid, but still it's being open to those perspectives is what really leads to truth. But unfortunately, that process gets stifled early on in the conversation. So I would say that,
especially on a college campus.
Yeah,
sadly,
we don't have to go on that road. But I think with regards to what's going on with the government intervention, I mean, they put a stake in the ground, right? And now they're trying to update and give information and show statistics to prove that they were right. Even though there may be some evidence that they made some pretty significantly, misled decisions, right? And so I look at it as, you got to understand where the information is coming from and be able to dissect that and understand what's really going on behind the scenes.
Consider the source. Always consider the source. Good points for sure. And look, many would argue that the powers that be are benefiting from these shutdowns, and they're making people dependent on government. And I mean, some of these shutdowns around the world are insanely strict. I mean, it is just unbelievable. And we've got to come to some middle ground here, some point of reason. It's just ridiculous. Yeah, go ahead.
No, I was saying, in a lot of the, in China, who's that, the news that went around about their people's doors being welded shut.
Oh yeah, and barbed wire being put around their apartment complexes so they can't leave. Yeah, all kinds of crazy stuff. But even to a lesser degree, I mean, what's going on in Australia is crazy. Puerto Rico, massively locked down, and Puerto Rico is part of the United States. Let's not forget that, right? In some of these left-leaning states and cities around the country, just incredible. Anyway, on the screen here, this goes back to what we were talking about the Fed last week. This is pretty significant news economically because they always have this target inflation rate of 2%, right? That's always the target, and they want that. And the reason they want this is because they're using something that economists talk about. It's called the Phillips curve. Okay, look up the Phillips curve. And what the Phillips curve hypothesis is that, there's this relationship between unemployment and inflation, right? And then, of course, interest rates that determine both of those things to one way or another, okay? And this relationship, the Fed believes there's a sweet spot to where if we target 2% as the inflation rate, unemployment will, barring a pandemic, right, will be to where it should be, right? And of course, you never have 100% employment because just not everybody will work. Most economists would argue that if you have 3 or 4% unemployment rate, you have basically full employment. Okay, so that's the target, and that's the Phillips curve equation. But this again is about how that whole new idea that they're not going to turn the ship in advance based on forecasting anymore. They're going to wait until we're in it, right? And I'd say that's a pretty inflationary concept right there. If that happens, that is inflationary. So pretty interesting stuff.
All referenced in his in his thoughts last week as far as using the Phillips curve and that being kind of a standard North Star. But yeah, it's one of those things also that's going to be thrown out the window. And I think it's also interesting when it comes to employment, where you have a brand new economy, right? And that's the thing that oftentimes central powers can't anticipate is human behavior, because human behavior is never predictable, but yet they're trying to always predict. So human behavior, whether it's the gig economy, right, and those working for Uber as contractors, those working for Grubhub or DoorDash, doing Airbnb, renting out rooms in their home, right? There's new ways of earning income that's difficult to track, and so the unemployment numbers, we're not very accurate to begin with, and even less so now. So it's interesting the direction that he's taking, because I mean, I understand that it's going to be challenging to really understand what the true unemployment numbers are.
Yeah, no, it definitely is. Patrick, let's talk to some of our listeners and viewers. Okay, so this one, oh, that's me. Hey, here's a nice one, Russell. Thank you so much. He says, "I'm so excited to learn from Jason and Patrick. I'm a client of both." Well, thank you for your business, and there's one of your clients, Patrick.
Thank you. Hey, Russell.
Yeah. And Muthaya, of course, we know Muthaya. He's great. Good morning to two of my favorite people. Well, Muthaya, good morning to you in Los Angeles. And by the way, folks, if you say, when you post a comment or a question, please tell us where you're located. Okay, we'd love to know your city. I know Muthaya lives in LA. And Muthaya, I haven't talked to you much about this, but you need to get out of the Socialist Republic of California. Let's make a plan. 5 years, 5-year plan. Okay. So I've been looking forward. This is Karina. Been looking forward to this stream. I'm also a client of both Jason and Patrick. Well, thank you, Karina. Appreciate it. Patrick, did you know you'd have so many of your clients on here today?
No, I mean, we posted and shared this. So I'm grateful, that everyone decided to spend their Sunday morning with us. That's awesome.
Yeah. Thanks for joining us for coffee talk. Yes, and Russell, thank you. Okay, so here is Jacko. Will the Fed ever reach their target of 2% inflation if the CPI is manipulated and the politicians who control the CPI hate inflation? The Fed will reach their target if the CPI is measured differently. Yeah, that's a good point. It's a good question. Patrick, any thoughts on that one?
If they do or if they don't, it's one of those things where I think, the way in which they're going, Powell indicated it last week, which is, they're trying to leave how they measure their success open-ended. And I think that's by design, right? They tried to, influence unemployment, and in the way in which they measured it, it was successful. But given, life, which is always unpredictable, you had a pandemic, and it's a global pandemic. And right now, I don't think there's any amount of money you can print to, essentially get back to the unemployment numbers that we were at before. So yeah, I look at, how they're going to measure it. And for me, I understand why they came out and said what they said last week, because they don't want to specify this is what we're going to do, because they may continually miss the mark. And right and there, it essentially starts to invalidate them more and more and more.
Yeah. So by leaving their definition of success open-ended, they can always just say, "Well, look, it worked," because
it worked here, or it worked here.
Right. Everything worked because we didn't really define what was success or what was failure.
We lost the game, but our shooting percentage, from 3 feet from the basket was higher than the other team.
Right, exactly. Yeah. Good point. Okay, Winston says, okay, you were just tagging someone Carlita, I hope you joined us as well. So thanks for recommending the.
Let me bring something up, which I think is interesting and on my mind. So, you had talked about Milton Friedman, and there are a lot of intellectuals that have made a really big difference in society, and oftentimes, I think we look at someone and because they make an error here, or they don't call something right here, it ultimately invalidates all that they do. And so Milton Friedman, what's interesting, because his Capitalism and Freedom, it's an incredible book. One of my favorites. It was very inspiring to me.
I like Free to Choose. I love that book. Yeah.
But at the same time, Milton Friedman is the one that essentially incorporated the idea of corporations, being able to be solely rewarded based on stock price. And I think at the time, I don't think Glass-Steagall was repealed, but now that it has been repealed, a lot of that philosophy has led to stock buybacks, and then this incredible bond issuance of all sorts of corporations that have driven up stock price, and unfortunately have hurt investors. So it's one of those things where Simon Sinek talked about that in his new book, The Infinite Game.
Yeah,
and I found that
Simon
really
Sinek is great, by the way. Yeah,
what he did in other areas, right? Because he made a massive difference in a very positive way. At the same time, there was some things too that he encouraged and motivated that didn't end up working out so well.
Yeah, that's true. Okay, here was a follow-on question from Jacko. The current strict lending standards make it impossible for new investors abroad to get a mortgage. Yeah. Well, look, this is that's the $1 million question right there. At first, the lending standards were way too liberal, and that caused the mortgage meltdown. And some of that, not all of that, by the way, there's a lot of misinformation about there. Some of that created the Great Recession, but not all of it. And then the banks basically, the whole mortgage industry overcorrected, and they've loosened a bit, but we'll see. And then for foreign nationals, it is hard. There are fewer options for foreign nationals to finance U.S. real estate, but there are some. Contact our team members through jasonhartman.com. And I know you've been watching the show before, so I don't know if you're in touch with our team, but they can refer you to lenders. Okay. Okay, another Jason. Good name, Jason. Jason Peterson. Does the impending asset inflation outweigh the recent price explosion in cyclical housing markets? So my regular followers will know that I talk about 3 types of markets: linear, cyclical, and hybrid markets, and they all act differently. And right now, I think what we're seeing is partially a result of pent-up demand. Look, traditionally, and I've been in real estate for an awfully long time. Over the decades I've been doing this, since I got my real estate license at 19 years old, and that was the start of it, and I've been investing for so long. Spring is always the big season. In fact, I've noticed that April is almost always the busiest month of the year. Now that we just have been working with investors for the last 16 years, investors exclusively, but I used to be in traditional real estate, that's always the biggest time. But this year, spring was entirely shut down. So when the quarantines and the lockdowns started to lift, a lot of that would-be demand was pent up and came out of the woodwork. But we got to be careful, and we don't know yet. I don't know. Okay, nobody knows that we don't misinterpret that as real consistent demand. Okay, and a lot of the people with money, and that's still a huge part of the world and the country. There's a lot of people with a lot of money out there. They moved to suburban markets. So, for example, New York City, all of our clients and my friends in New York City tell me, and they send me pictures of moving trucks. There are just moving trucks everywhere, emptying units in New York City. And they're going to the neighboring areas, which are cyclical markets, and they are expensive. Cyclical markets are expensive markets. So they go to Westchester County, they go to the Hamptons, they go to expensive Connecticut areas, and all those surrounding areas that are lower density and suburban in feel. And so there's a lot of money flowing out of the high density New York City markets to those surrounding areas, which are also high end. But I think the cyclical market trend, even though it's doing pretty well now, was over before COVID 1984. That was already showing severe softness. And I think it will, once this pent-up demand sort of equalizes and reaches a level of homeostasis, we will see a more normality there once people have made their move. But remember, New York City has a population density of over 27,000 people per square mile. Think about that for a moment. That's a lot of humans and a lot of units and a lot of money. that can move and flow out of that city, and it is certainly flowing. And the same is true in downtown LA, in any high density area. Look, as I've said for a long time now, the two biggest danger zones are elevators and mass transit. So if you own property in a high rise condo right now, you want to liquidate that, because I do not think that has a good future. Now, add the fear of infection, add that to civil unrest. These exact same areas, the high density urban areas, are experiencing the civil unrest and the riots and so forth. So it's like a 1-2 punch, right? Get out of those areas. So Patrick, any thoughts on Jason's question? If not, we can move on to the next one. But
yeah, and so the impending asset inflation, I think impending assumes that it's about to happen. I would say, is inflation going to continue to rise? And I would say yes, because I think the Fed is just going to continue to print and print and print. They want growth. And so as far as housing markets are concerned, that's your expertise, Jason. I mean, I can speak to what I look at and follow. I mean, I think Utah is a very unique place. We have, number one, the lowest unemployment in the country, but we're close enough to California where we're seeing just tremendous growth in housing, and it's mostly the apartment space. My next door, well, 2 doors down, he's an architect for a very successful firm here that does multi-hundred unit complexes, and they're a year out. I mean, they're not even looking at stuff right now because of how busy they've been. There's 25 to 30,000 people moving here per year that do not have a place to live. So it's interesting where you have, number one, that was kind of happening anyway, but now you have companies going remote and not requiring people to be in a physical space. I think that's going to last a long time, frankly, especially with more of the tech companies. And I think that's going to change the flow of where people want to. And it's not going to be in those urban areas, because even though there's some, pros to being there, I think there's in some sense more cons than pros.
I agree with you completely. People have realized that the city is just highly overrated. And I love to visit cities. I love walkable communities. I've lived in a few and really enjoyed it. When I lived in Arizona, I lived in walkable communities. I just loved that I could walk out, go with the dog, go to the coffee shop, go to the restaurants. It was great. But again, I think this is it's a tectonic shift we're going through. Jason had another question, by the way. I'll just take you to. I'll just put that on the screen.
Wrap up on that. I look at those urban areas, and I think there are some people that love urban areas, but usually from what I understand, they grew up there. That's part of like their life. They didn't move to it in order for employment, but there's a lot of influx into those urban areas, whether it's California or the East Coast, that was because of employment, but it wasn't the place that they grew up in. And so that kind of natural desire to go to, more suburban, open areas, less expensive areas, I think that's, really what's driving some of the behavior to move out.
Yeah, absolutely. So Jason has a follow-on question, meaning savvy investors should still take asking prices. I think you meant to say, do you mean, are you talking about as a buyer or a seller? I mean, I'll try and answer what question I think you're asking. If you're looking at urban property, you should sell it mostly. I mean, I can say that as a blanket statement, but there of course are exceptions here and there. If you're buying in suburban markets that are, good, the markets we like are those good, cheap, linear markets where, you can get really good rental properties for $150,000, give or take. I mean, it depends if it's, resale and renovated or brand new construction is going to be more expensive. You got to pay asking prices. I mean, it's like a bidding war in most cases. So you're not going to be able to negotiate very often. It's really, really very, very very much a seller's market. But I think the future is going to be even better. So, there's that old thing in real estate, in the cyclical markets, the supply is called the greater fool theory. And this really applied mostly to California in the good old days, in the heyday of California, which has long passed. Okay, that's over. But
I have a comment here, and I know we got another question that came up, Jason. But when you're accepting an ask price, I'm assuming you're selling, right? So when you sell, you also have to realize that you have to put the money somewhere. So that's where I look at, all assets, all resources have alternative uses, right? So because I've heard and I've gotten questions from clients who are getting these amazing offers. At the same time, it's like where to put that money and have the same type of cash flows. And especially if it's in real estate, having the very tax efficient cash flows, it's more challenging than you would think.
Yeah, no question. There's always an opportunity cost to everything.
Yep.
And that really goes back to what my listeners have dubbed the Jason Hartman question, which is compared to what? So your money has the compared to what question. If you have a bunch of equity tied up in a property or in, gold or in stocks or whatever, anything, right? Or in the bank, it represents an opportunity cost because it's not being used for something that might be better, right? That's the opportunity cost. And everything has an opportunity cost. Back in the days when we used to go out and socialize and have fun, like it's the old days, right? If you made one decision to do one thing with one group of friends and go out to dinner with them, you couldn't go out to dinner with your other group of friends, right? There's an opportunity cost to everything. Everything is you close one door, you open another, you open one, you close another, right? That's just the way life works. So something to keep in mind there. Okay, let's get back to DM's thing. Okay, so DM says, Jason, what are your thoughts on virtual real estate investing in Fundrise and app style investments? If Bitcoin is just as good as gold, why can't crowdfunded real estate investing be different than physical? Well, you have not studied, DM, I can tell by your question, my 10 commandments of successful investing. And commandment number 3 says, thou shalt maintain control. Thou shalt maintain control. And this is probably the commandment that has resonated with my followers more than any other commandment. And what it means is that you should be a direct investor. You should maintain control in the thing you're investing in. When you buy properties through our referral network, you're basically buying the property. You own it. Okay, it's yours. You can decide what to buy, where to buy, when to buy, who to buy it from, how much you want to pay for it, as long as the seller will agree, of course. How to finance it, when to refinance it, when to sell it, when to do a 1031 tax deferred exchange, how much you want to ask for the rent, who to rent it to. All of these things are under your control. When you relinquish control to somebody else, when you buy stocks, bonds, mutual funds, or you invest in a crowd-funded deal, you're basically relinquishing that control to somebody else, right? A board of directors, the CEO of the company. If it's a fund or a private placement memorandum for a startup business or an apartment syndication, someone else is in control. And you leave yourself susceptible to 3 major problems. Number 1, you might be investing with a crook. Okay. And, we're all familiar with all the scandals on Wall Street. There are certainly tons of scams in real estate and every other investment under the sun. So you might be investing with a crook. Number 2 problem, you might be investing with an idiot. and you'll lose your money because of their crookery or their incompetence. Number 3 problem, assuming they're honest and competent, they take a huge management fee off the top for managing the deal. And, a lot of times they're not attached to the outcome of the investment. They're simply gathering everybody else's money, and they don't even necessarily have their own skin in the game. Yeah, they want to make it work because they can get their fees, but when you invest in these crowdfunded deals, there's a whole bunch of layers of fees in those deals: acquisition cost, disposition cost, this management cost, that management cost, and all these little handling fees. And then what really bugs the heck out of me is the promoter of that investment. Many times, I'm not saying all of them, but many of them, they will be using your money, your investment money, as a way to promote it to other investors. How That's ridiculous to me. That should be a cost of them running their business. So if they go and wine and dine another investor, you could be paying for that. That's ridiculous. Okay. And this is totally legal most of the time. It's fine for them to do that. If they go do marketing and buy advertising to advertise that opportunity to other people, you're paying for that. That should be an external cost, in my opinion. It shouldn't be part of the fund's cost for you to pay for them to bring in other investors. That's not a fair deal, right? So, Patrick, any thoughts?
Well, yeah, I have several. So they mentioned the company Fundrise, and also the idea of crowdfunding, and how I would say capital formulation is evolving. It's very new, and so you get caught up in quite a bit. You get caught up, obviously, in fees, mismanagement, and risks that you have no control over. At the same time, I look at the whole idea of being with the first innovator. You're always going to end up with arrows in your back.
Yeah. Well, what Patrick's saying is the old saying: how do you know who the pioneers are? Yeah. They're the ones with the arrows in their back. Okay, so yeah, go ahead. So
I think it's intriguing because my neighbor is one of the founding developers for Carta, and Carta is the technology platform that manages the majority of tech company ESOPs, and employee stock ownership plans. And he's brilliant, but Carta is pioneering the way in which capital is being formed. And we saw some recent SEC definitions of accredited investors and the ability to invest in private companies. A lot of that's been lobbied by this group, and it's making it easier to do. And I believe that it's going to be part of what kind of compresses the wealth gap when it comes to how people are compensated, where it's going to go from wage to wage plus potentially ownership when they make it easier. So I think there are groups out there that are like pioneering, and that's what you got to be cautious about. I got to know the founders of Fundrise when they first started. They were part of a summit that we used to do called the Cash Flow Wealth Summit. Jason's spoken on that before.
Right.
And I invested a little bit of money because I was intrigued by the platform. I was intrigued by what they were doing. And I think they've been very successful because they've been able to crowdfund. But what that does is it reduces fees, and it reduces, how you own real estate, and you own it more like a REIT than you own it as an individual, where there's lots of tax benefits. So from a gross standpoint, you can argue that maybe the return is worth giving up some control. But from a net standpoint, how you're taxed, unless you hold it within, like a self-directed Roth IRA or something like that, then you don't get those same tax benefits. Plus they operate really without your consent. You're just giving them money. So I think there's really some interesting things going on with how capital is being formed. And especially in the tech space, you're reducing a lot of the expense associated with it. But you got to do your research. You got to understand it, understand the founders. There's so many different elements that go into that. But as Jason alludes to, there are ways in which you can mitigate that by, doing it yourself and getting a very similar return and more tax benefit.
Let me tell you something I've noticed about this. By the way, Russell, thank you for the absolutely comment. I'm glad you agree. Over the years, I have noticed that there is this mindset of sophisticated people. Okay. And that is a damaging mindset. It's hurting people. Folks, keep it simple. Just buy some houses and rent them out. You will get rich. It has worked for millions of people. Okay. This is the most historically proven asset class in the entire world. Now let me drill down on just one little component of that. Okay. A lot of people think it's, they're too sophisticated to just buy some little houses and rent them out, right? They think, oh, well, I got to invest in this real estate investment trust. That's a REIT that Pat mentioned a moment ago. Or, I'm going to invest in this big deal. Well, think about the assets behind, what's being offered on these crowdfunding platforms most of the time, not always, but most of those assets are office buildings and shopping centers, and those things are sucking wind. I mean, it's an epic disaster in those asset classes now. Everybody needs a place to live. Let them rent it from you. Okay? Housing is the center of the universe, especially in a COVID era. Okay? And people now, they want to be out of the high density areas. They want to move to the suburbs, and they need more space. They can't live in that, 1 or 2 bedroom place in LA or New York or whatever, right? Or downtown Seattle, maybe in Chaz, or I think they've changed the name of Chaz. Is Chaz still in existence, or is the country overthrown yet? I don't know. I don't know the answer. Anyone from Seattle out there, let us know. I hope it's been overthrown by now, but we'll see. Anyway, downtown San Diego. It's not like you have to be in a big city. I mean, there's all kinds of high density stuff in downtown San Diego, all right, or LA. Yeah, San Francisco certainly is another one. Just buy some houses. People don't need 1 room for a home office anymore. They need 2 or 3 rooms for a home office now. The kids are learning at home. 2 adults are now at home working out of the house. The gym is closed. They need a place to work out. This is just a total shift here, folks. Office properties, retail properties are being creatively destroyed, to use the Joseph Schumpeter concept. My favorite economist, Joseph Schumpeter, who coined the phrase creative destruction, okay, or at least popularized it. Maybe he didn't coin it, I'm not sure. Anyway, JJ says, hello from Bahrain. Oh, wow, that's cool. Isn't this great? It's an amazing time to be alive. Welcome, and thank you for joining us.
So I'll say something, Jason, I think is interesting. I heard a speaker a few years ago that wrote a book called How the Market Cycle Works. And he was it's a big venture capital guy. His name's Howard Marks.
Mm-hmm. Oh, yeah, Howard Marks, sure.
Yeah, so Oak Tree
or something, yeah.
Right. And after that, it really, the investor behavior cycle really intrigued me, which is, really where the overarching sentiment of investors, whether it's fear or euphoria and greed or concern, right? I think most investors in aggregate are essentially emotionally investing. They're making decisions emotionally. They're not making it rationally.
Right.
And he basically proves that even the most sophisticated investors to that,
Yeah.
And so
listen, I'm so glad you mentioned that, Patrick, because folks, you've got to realize something. A lot of the sophisticated people and educated people aren't really that brilliant, amazingly, and they're not that sophisticated, and they're not as smart as you think they are. Okay. Just use common sense. Okay. Common sense is in short supply. And, people are people, no matter how educated they are or how famous they are. They make decisions emotionally just like you do, just like everybody else does. Yes, they rationalize and justify them with logic. Sure, they do. Oh, yeah, I want a new Ferrari because it certainly won't get good gas mileage or be cheap to maintain, but it'll go up in value. These cars hold their investment. They make all sorts of rationalizations like this.
Yeah, we're masters at rationalization and justification.
All of us
masters.
are. Yeah.
What
else were you going to say about
always
that?
a reason.
Yeah.
But I look at, again, as you look into the future, I think looking in the past and understanding hindsight is one thing, but looking into the future, use that as one of those variables where you understand kind of where the emotional curve is, because no matter the sophistication, people always kind of, they're driven by multiple things. And I think you have, some that don't have as much emotion involved in it, which are typically the, successful entrepreneurs.
Mm-hmm.
But oftentimes you do. And so that's where I think on the other side of that emotional curve is where the opportunity is.
Yeah, absolutely. Good point. Good point. Okay, so Nathan is asking, Nathan Lau, I'm considering buying a home in Orange County, California. Hey, that's where I spent most of my adult life. Love Orange County. What are your thoughts about that real estate market? Well, first off, Nathan, Orange County is a big place, population, what like 3, 4 million people. And so, where in Orange County is my first question, and what price segment? So, remember something when you think about markets, everybody. It's not just about the market, the geography. That's certainly one thing, and that does matter. But it's also about what are you buying in that market? What type of product? Is it a condo, a detached home? Is it a high-rise condo or a low-rise condo? In Orange County, most of it's low-rise. If it is a condo, and is it luxury property? Is it low-end property? Is it in the middle? There are a lot of questions here, right, that have to be answered. But I would say overall, the answer is no, Nathan. Don't do that. Okay. Orange County is a beautiful place, and it is a very expensive place by and large. And, you could make that money work so much better. I remember when I first started in this business back in 2004, and I hired a graphic designer, an illustrator, and I wish I had a copy of this because it really show you. And it was I had him do an illustration of the U.S. map, and there's that old saying, "Your home is your castle," right? We've all heard that saying. It's an old saying. Your home is your castle, and what I designed this ad that was in OC Metro magazine, by the way. It ran in there many times. You can maybe go find an old issue and you can see it yourself. And it said, it had a picture of the US. It had a little icon of a castle in Southern California. And then it had arrows coming out from that castle into other markets in Texas, Georgia, Florida, Tennessee, all the markets we were recommending at the time, right? And we still are, interestingly. And the caption for the ad was, "Turn your castle into a kingdom." Turn your castle into a kingdom. For the amount of money you're going to spend on a home in Orange County, you could much better rent that same place in Orange County, and the rent to value ratio would be favorable to you as the tenant, not to the landlord, because buying a rental property in Orange County would never make any sense. It's too expensive. That's a cyclical market. It's an expensive market. And the rent to value ratio there is typically like a 0.5. So you might buy a $600,000 property that rents for $3,000 a month, 0.5% of the value. Whereas we target around the country in the markets we recommend through our referral network, we target a 1% rent to value ratio. Now that's getting pretty difficult to achieve, but you still might get 0.9 or 0.8. Whereas, and just to make the numbers round, okay, $100,000 property rents for $1,000 a month. So if you bought 6 of those, the $600,000 Orange County property I'm using the example of, you'd get $6,000 a month, give or take. Okay. Whereas in Orange County, you're going to be using a $600,000 asset that you could actually rent for just $3,000 a month. So you get what I call a double arbitrage, where you are getting the highest rent to value ratio from other people that rent from you, yet you're renting from someone else and getting an advantageous rent to value ratio for you as the tenant. Okay, so you're winning on both sides of that equation. So double arbitrage that. Sometimes it's really better to be a renter, and the higher you go up in price, I mean, in Orange County, you can spend millions of dollars on a property, and the higher you go up in price, the more favorable the rent to value ratio is for the tenant. Okay, and the lower you go in price, $100,000 property in Memphis, for example, or $200,000 property in Atlanta. You can go to jasonhartman.com and look at properties like this right now. your rent to value ratio is favorable to you. Okay. And that's what you want. You want to get the numbers going in your favor, not someone else's favor. So the rule is own a lot of inexpensive rental properties you rent to other people, and rent an expensive home for yourself and get the advantage both ways. Okay, Russell is saying.
Can I add something to that, Jason,
Yeah,
before
sure.
we get to Russell's comment? Yeah. So I'm assuming from the question you're saying home instead of property, which leads me to believe primary residence.
Yeah.
So I think with primary residence, you have a couple things going on, making the decision purely off of economics, right? May not be
fair point. Fair,
right?
Yeah, so that's fair.
What I do, and I've done this for a second home that I have a primary residence, is I weigh the opportunity cost. And so if you look at first and foremost, everybody needs a place to live, right? So you're going to spend money living somewhere. So Jason alluded to it. You want to find what the market rents are for a primary residence, what you would rent. Then you want to compare like the expenses that you have to pay and so forth, up to actually putting money down, right? So primary residence, you got to put some money down. That's going to be an investment. You get some tax benefits, but you also have maintenance costs. You have maybe some like insurance. You have property taxes. So you got to look at and weigh, okay, I'm going to invest money in this. Am I really going to get a return on that relative to another place that I can allocate that capital? And as Jason put it, it's one of those things where if this is a primary residence and this is where like you want to live, and there's not the ability to rent in that area, okay, that's one thing. But if there is, you can make a comparison and have the logical approach to it. At the same time, I had to concede to some spousal demands when I did our primary residence. Yeah. And I would have much rather, done something different with it, but you have to give, consideration sometimes.
Hey, Patrick, when
allows you to make a better decision, regardless of the decision that you make.
Yeah. Happy wife, happy life. And Cynthia, hi, if she's watching, that's your wife. Understand, and my disclaimer, Nathan, will be that I was only coming at that from strictly an economic perspective. But I'm definitely right about that. Okay. I'm right about the economic perspective. Of course, there are things that we spend money for that are just personal decisions. But if you're trying to be logical and analyze it logically, I would say, definitely my advice holds. Okay, so that's my disclaimer. I was only coming from it from a financial standpoint. Okay, Russell says, I live in Yorktown, Virginia, originally from the California Soviet Socialist Republic, the CSSR. I call it the Socialist Republic of California, but I like that. That's a good one, Russell. Okay, so Peter says, Colorado, really appreciate and enjoy the live stream. Keep it up. We will. Thank you, Peter. Appreciate that. Okay, Steve Mitchell. Good morning from Michigan. Where on the hand? See, when if someone's from Michigan, you hold up your hand, and where are you from? So anyway, what are your thoughts on the risk to investment?
An egg smoker too on his profile picture.
What's that?
An egg smoker.
Is that an egg smoker or a pressure cooker?
I think it's a smoker.
Okay, I don't know. Yeah, okay. Yeah, you're more in tune with that than I am, for sure. Okay, what are your thoughts on the risk to investment property owners posed by COVID-related eviction moratoriums? This is a good question. Thanks for asking. Which may be seen as opportunity to stop paying rent by some tenants. That's a great question, Steve, and it's one that a few months ago we were very worried about. I got to tell you, though, non-existent concern. All of my tenants are paying their rent. It has been just a non-issue. Now, the media loves to sensationalize things. I do think it has been a little bit of an issue in apartment buildings. You got to remember something. And listen, I own multifamily units. I've owned many more. I just sold a big complex. I had 139 units that I owned with one of my clients several months ago. And I've had many multifamily units. The single family homes, though, are my favorite. And one of the many reasons for that is this one, is that and institutional landlords with apartment complexes have had more of a problem with rent strikes. And what you have to realize is that when you have an apartment environment, you have people all together where your tenants are all talking to each other. Okay. They're neighbors. They talk to each other. Hey, Joe, are you paying your rent? I'm thinking of not paying mine. I saw this in the news about an eviction moratorium. And they gang up on you. They form a mutiny. Okay. But with a single family home, you might even own 3 houses on that street, but the tenants won't know that you own them all usually. I mean, it'd be very rare that they would. So they can't organize and strike, right? Like a labor union. And so remember, your apartment complex is going to have a Yelp page and Yelp reviews. They're going to review you. It's like a business, okay? You got to be really careful and conscientious about this stuff. So, it's just a whole different dynamic. And that is another of many advantages of single family homes. But, knock on wood, the rent strikes just have been a non-issue. Even with eviction moratoriums, people are still paying their rent. Okay, so granted, I'm sure there are cases you can find of people not paying their rent, but so far with our client pool, I haven't heard of any real problems. Okay, so oh wow, there's a whole bunch of new questions. Pat, feel free to bug out anytime you like. By the way, I appreciate you staying this long, but we've got some more questions to dive into. Okay, Sergio says, hi, Sarah. Okay, so let's see. Hi, Russ. Glad you're here. Okay, just dropped my daughter off at college in Nashville. Plan to buy a multifamily property. Oh, well, there you go. Now, when you say multifamily, Russell, I have a feeling you're talking about a plex, like a duplex, fourplex, triplex. That's not the same, although it does have some of those possible characteristics I just mentioned that, but the LTI, now, by the way, that is my ratio he's talking about there. I made that one up many years ago. I call it the LTI ratio, and we should do a whole live stream on this. On my YouTube channel, there are some great videos on this. My podcast has some great podcasts on this. And LTI means land to improvement ratio. That's what Russell's talking about here. Land to improvement. When you buy a property, remember you're buying two things. You're buying the land and the improvement, the house sitting on the land, for example. And this ratio is something, it's a ratio I invented, and it's something that can really be helpful in analyzing and mitigating risk in a real estate deal, okay? Seems too high to invest according to your strategy. Got 2 properties in Memphis. Should I stick with Memphis? Well, and forget about Nashville. Well, Russell, we've never been able to make Nashville work. Now, I love Nashville. I think it's a great town. I actually considered moving there myself because, Tennessee is a no-income tax state. So it was on my list. And I've been to Nashville many times. I like it. It's a good place to visit, but the properties are just too expensive. We can't make them work in Nashville. So Memphis, the rent-to-value ratios still work. But listen, if you've got 2 in Memphis, check out one of our other markets. You want to be diversified. You want to be in at least 3 markets, not more than 5 markets. Okay, so you do want to diversify. Okay.
I think another. I'll chime into this again. Yeah. You have some non-tangible elements where you have the pure economics of it. Mm-hmm. So you want to run an analysis, run a pro forma, see if it makes sense. But you have some non-tangible, especially as it relates to your daughter. You have to pay rent somewhere.
Yep.
Okay. So that's one thing to take into consideration. But also you're going to get probably good tenants because they're, your daughter will most likely not accept, people that are a certain way. So hopefully the property will be taken care of. So you'll have lower maintenance costs. I think also property management. I mean, if your daughter does that and pay her to do that, that could be a non-tangible. Plus just the experience of owning it could be a non-tangible. So again, you have to weigh all of this. There's not always this pure vanilla and chocolate, right? It's basically, let's figure out, all right, is it worth it based on the tangibles and the non-tangibles?
Fair enough. Very good point. There's more to it than that. But there's one other thing I didn't mention that is really important. And that is that, remember, the whole university government debt enslavement complex, thankfully, Many good things coming out of this COVID situation is being totally disrupted, and it's about time. Colleges and universities have been ripping people off for decades. Tuition is a scam. It is totally overpriced. And, all of these college towns, I've talked about many articles on my podcast about how the real estate markets are being totally disrupted in these college towns because the kids just aren't coming back. And what people are seeing, fortunately, and this is really good news, is they're seeing that, and this has been going on for years, that college is just an overpriced ripoff, number one. But number two, they're seeing that they don't need to be there, that they can remote learn. And then they're asking themselves the very logical question, why am I paying $20,000 a semester for my kid to sit in front of a computer screen on their laptop when, like everything else in life, it's totally scalable? I mean, one professor, the best professor in every topic, in every subject, could teach the entire planet the topic. This is absurd. There is no limit to the scalability of online learning. And these colleges, these universities are basically hedge funds. They're big real estate investment trusts. In any college town, you go there and you notice that the college is the major real estate investor in the whole city. What a scam. That's not what you're paying for. You're paying for education. It's a total ripoff. Listen, I'm all for education, but it should be reasonably priced. The cost of going to college should be $2,000 a semester, not $50,000. Okay? It's absolutely ridiculous. It's a total scam. Okay? And the world is waking up to that. Student loan debt now totals about $1.5 trillion with a T. It is the only debt not dischargeable in bankruptcy, which means those kids that have been saddled with this rip-off debt, and most of them got some useless liberal arts degree, okay, that nobody's hiring for, feminist studies, okay? Yeah, they're hiring for engineering, sure, that's a good one, okay, or medicine. Those are good. Those are real degrees, okay? They can't get a second chance. They got to pay that debt no matter what. It's not dischargeable. You can't get it. You can't start over. So be really careful of the college model. It's being disrupted.
And I would use the same logic as approaching real estate, right? You have the logical side of things and you have the emotional side of things. And that's where, I would say emotionally, I think within our culture, there's this like kind of rite of passage that everybody is inclined to do, whether they rationally think through it or not. So I think there's going to be a demand there, but this goes to really people that are sending their kids to college, where you got to do an economic analysis up front. You got to understand, like, okay, here's the cost that goes into it. And it's going to be probably 5 years with most, and then maybe a graduate degree to really get, an income that's worth it. But then you look at the amount of input that went in there, as well as the opportunity costs right, associated with what that money could have done. And you got to weigh those, understanding the logical economics of it, as well as the emotions, is going to allow for a much better decision. And I also say that, when it comes to the output of anything, a good return on investment of anything, it's the environment of accountability. And when kids are essentially involved in the discussion and know the costs, know the opportunity costs, know the economics, then hopefully the environment is different and they're going to treat the experience differently and put the educational expense into something that's actually going to have a more productive use in the end.
You know what you could do? You could get your kid several internships lined up where they go work for free for a bunch of different businesses, and they will learn so much doing that, okay, by getting coffee for the boss, okay, and just being around and hanging around in a real company and just seeing how it operates. But also, with the cost of college tuition, you could literally buy your kid one rental property every semester. Think about that. They could have 8 rental properties, and it could be their job to manage them. And think about how much they could learn about that. One rental property every semester. That's the cost of college. And that's not a super expensive college. If it's Harvard, it's 2 rental properties every semester. Okay? Think about that. 8 rental properties or 16 rental properties by the time they'd graduate from college. I mean, and a bunch of internships and a bunch of property management experience. That'd be a way better deal than college. Okay. And listen, I'm not against college. If it was reasonably priced, I think it'd be great. I just think it's just totally overpriced. Okay. Okay. Let's just get through some of these questions quickly here because we got to wrap it up. Okay. So Jason Peterson, again, what are your thoughts on the prospective performance of residential versus commercial versus agricultural real estate over the next 10 years? Look, everybody needs to eat. Farmland is required to produce food. Conceptually, I like agricultural, but the yield is not good on agricultural properties. Farmland just does not produce much income. Okay, the yield is just not good. So, in commercial, when you say commercial, I don't know what you mean. People use that commercial, they say that, and I don't know what that means. Does it mean shopping centers, office buildings, industrial properties? What does it mean? So I'm guessing you mean most people, when they talk about commercial property, they're talking about office buildings and retail properties like shopping centers. Terrible, terrible. I mean, COVID has just destroyed those businesses, and they are not coming back for a long time. There's a giant glut of those properties already in existence. So don't touch it with a 10-foot pole. Housing is the center of the universe. Look at Maslow's hierarchy of needs that you learn in college. For too much money. You could have just looked it up on YouTube. Okay. Anyway, the bottom of that pyramid of the hierarchy of needs doesn't exactly say this, but it's basically that old saying. What do people need? Food, clothing, and shelter. Let them rent the shelter from you. The only must in the real estate equation is housing. It's the only required asset class. Okay, Sarah, one of our
let me make a comment quick on that. So I would say again, what mitigates risk with residential is supply and demand, right? The demand for residential, everyone has to live somewhere, right? So I think that right there makes it simple to make an investment and have predictable outcomes. When it comes to commercial and agricultural, that's where I think there's more specialization. I think what's really going to be interesting, I think definitely some asymmetric type of opportunities, asymmetric risk reward, is when a lot of these shopping malls and centers actually go into bankruptcy, rock bottom prices, and somebody figures out how to have
a reuse,
a yield based on some other service, right?
Mm-hmm.
But that again is very specialization and much higher risk because I think there's going to be some experimentation in there. I think it's going to be intriguing to watch.
Yeah, it will be intriguing to watch. They will eventually create alternate uses out of these properties, these retail properties. And there's a lot of talk about that now. In fact, there's an entire YouTube channel just dedicated to how to reuse shopping malls. And I've been watching some of the videos, and let me tell you something, folks, that is no easy task. First of all, you've got to get the zoning approved, which nothing's slower than the government to, make new decisions about things. But I mean, it is a monumental task. A lot of the talk is that it's just better to, take the bulldozer and the crane and knock these down and just build attractive houses. It's very, very expensive to reconfigure these properties. So, not a high likelihood, but we'll see. Okay, so Sarah is really just talking with one of our clients in the thread here, but Sarah, great comment. Yeah. So I may see that question here in a moment. I'm not sure if it was one that I answered already. Okay, I love this. My tinfoil hat's on with us every week, and I love your handle. Referring to conspiracies, my tinfoil hat. So Seattle landlords selling out and moving to a farm. Free rent doesn't work for me. Okay, that's probably about my Chaz comment, I guess. And SG says, thank you, Jason. You're welcome. Okay, so Nathan, with his prior question, Irvine, California. I lived in Irvine for many years. I made tons of money selling real estate in Irvine over the years and investing there too. Detached single family home, 3-bedroom, 3-bath, new construction for $860,000. Oh, Nathan, I don't want to say don't do it and then see the value go up and you'd be mad, but let me tell you, you'll make more money buying 8 inexpensive single family home rentals through our network in 3 diverse markets and investing in them, and you could rent that house. And you know what else? You're going to have special
rents.
You're going to have special Melrose tax assessments and high association fees, I am sure, because I am all too familiar with Irvine. I'm guessing that's in the in the new Northwood area. I'm guessing based on the price and everything. But the real estate company I used to own in Irvine is still there. It's on Barranca Parkway, okay, in West Park. So, I would say don't do it, Nathan. There's just the real cost of that house is so high in an area like Irvine because of those special tax assessments. And California is just listen to my podcast about what California is doing. I mean, it is shocking. They're going to probably overturn Prop 13, and your state taxes, which are the 1% base, could just massively increase. In addition to the special assessments, the city taxes, the Melrose Assessment District, or whatever you've got there. I don't know the specifics. And then your association fees. The true cost of that house is a lot higher than you think. And the future cost of it, and California now trying to raise the income tax. And and this new tax they're proposing about unrealized capital gains. They want to tax people on this, and then a wealth tax. I mean, people are fleeing California. The Socialist Republic of California is in major trouble, Nathan. So I would not be buying property there right now. Patrick?
Amen to that. They're grasping for every last straw to solve an internal problem, mostly with entitlement benefits. CalPERS is a disaster. Obviously, you have
that's the California Teachers Retirement Fund or Public Employee Retirement Fund. Yeah.
So it's going to be interesting how that shakes out, and they're going to do everything, and that's in their power to get money to solve that problem.
Yep.
Instead of bankrupting that problem and allocating resources and making it reasonable, because it is not reasonable. That the system that they have is just it's not reasonable. It's not sustainable. But that's the only power that they have is to tax.
Yeah.
Right?
Nathan, let me tell you something. Everybody listening
is not the people that they're taxing.
Everybody listening has got to hear this. This is really important. Nathan, you especially, but everybody listening needs to hear and internalize what I'm about to say. You never want to live in a place under a government that is desperate for money, because when you do, you know that they are coming after you. They are predatory. They become predatory on the citizens to try and collect money from them. Okay, so that does not bode well for a good future. Hey, our client Drew Baker is joining us from the car. I'm going to put him on for a minute, Patrick. Hey, Drew, how are you? Oh, I don't know if it's going to work, but it's not going to work, I don't think, on the car. Okay, so oh well. He lives in California, and he and his wife have been talking about what's going on there politically and all that stuff, and it's just crazy. So I thought he might have a good comment about that. But I asked him to join the live stream if he can, but I don't think his connection's going to be fast enough from the cell phone. But we'll see. Well, maybe it is. Here, I'll try and add him. Drew, how are you?
Good. I made a joke that I was enjoying California, but
yeah. Drew, I don't know if you and Patrick know each other. You may, but what do you think about these ridiculous California taxes?
Well, I think it's, like you said, a slippery slope, and it's it's funny because you guys know this. You remember 20 years ago when you told people you were from California, when you go to some conference, they would think you were like glowing or something.
Yeah.
I mean, they thought you were amazing. Now you're like a pariah.
It's like you've got COVID.
Yeah.
Get away from me. Don't tax me. Yeah. Yeah.
These,
no, I know.
Signs saying, if you come here, don't bring California with it,
Yeah, right. That's what he's referring to. And Drew, your sound isn't so great.
Let me try putting a headset on.
Okay. What he's referring to, folks, is there used to be this bumper sticker in the 80s when everybody was coming to California that said, "Welcome to California. I'll go home. But now the trend is the opposite way. And what they're saying in places all the Californians are moving to, in Texas, for example, they're saying, people, they're surprised because people have been fleeing California because they don't like the liberal government that's taxing and spending, yet they're moving to Texas or wherever, lots of places, Arizona, Texas, Utah, Georgia. I mean, they're moving everywhere in the country, right? And they're bringing that same government with them. They're running for city council, and they're like, well, why not just tax and spend? That's what I know from California, right? So yeah, it's absolutely crazy. Drew, is your sound any better now? Are you there?
Well, hey, Jason, I think my audio is
much better.
much
better. No, it's better. You can talk.
I will try to go to another computer.
Okay. All right. We'll see you later. Thanks for trying to join. Okay. So let's get to the rest of these questions here. We've got one from Ellen Bain. Thanks for all you both do. Thoughts on Delaware? A Delaware statutory trust, I think is what you're talking about, a DST for 1031 exchange in real estate environment. That is a complicated question. And Ellen, I want to recommend that you and everybody listening check out our free webinar on asset protection and estate planning. It will help you with this. Go to jasonhartman.com/asset, jasonhartman.com/asset, and check out that free webinar. Get in touch with the attorney that does that webinar, and he will help you with that. Okay, he's really doing a great job for a lot of our clients. And again, that's jasonhartman.com/asset. Also, I think this is the right link, but we've got a great webinar on 1031 tax deferred exchanges, or reach out to one of our investment counselors and they can connect you with a 1031 exchange specialist and directly with the asset protection attorney. But the webinar would be a great start. I won't give too many links. I think that other one, though, is jasonhartman.com/1031 for a free webinar on 1031 exchanges or tax deferred exchanges. A great tax benefit. I've used that vehicle many, many times. It has enriched me greatly. So check that out. Ellen, that's just a really long question. We need a lawyer here to answer it, or a 1031 exchange expert. So we'll do that on a future live stream, but I have many podcasts on that as well. And of course, the webinars. All right. And we're going to wrap it up here in a few minutes, folks. SG is asking, we are thinking to buy an apartment in Manhattan. Do you mean Manhattan Beach or Manhattan, New York? I hope you don't mean Manhattan, New York, or Manhattan Beach for that matter, but either one of them is, I would not recommend.
Probably New York.
Yeah. What's that?
They're probably referring to New York.
Yeah, no, don't do that. Gosh, first time home buyer, we've been renting for 3 years and waiting for the right time to buy. Don't do it, SG.
First time home buying experience in investment property.
Yeah. If you're talking about Manhattan, New York, or Manhattan Beach, California, either one of those is super expensive. You're probably talking about New York when you say buy an apartment. That's, in Manhattan Beach, they'd call it a condo. Don't do it. It's just way too early. You don't want to be doing that. Okay. Not a good way to spend your money, especially as a first-time buyer. Just continue renting, buy some inexpensive investment properties in diverse markets, and you'll be much better. Okay, so Drew is back here with us. We've got Russell's question. I agree, Jason, which is why we're using Patrick's infinite banking perpetual wealth system to fund my daughter's education and income property investments. Russell, I'm glad you're using Patrick's system for that. But the question is, why not just use it to grow rich rather than fund an overpriced college, right? It's just a thought. And again, like Patrick alluded to, these aren't all completely financial and economic decisions. And also, of course, what kind of kid you have. Some kids need the structure of college. Listen, I went to college for 2 years. I didn't finish, and I did very well. Okay, but it depends on the kind of kid you have, right? And you're the parent, so and I'm not giving you advice on that. So I'm just trying to tell you, I think that when kids go to college, they should go to community college for the first 2 years, and that's super cheap. A lot of times they don't know what they want to do. Okay, and then they can switch to a state school. If you're an in-state resident, it's going to be a lot less expensive. Just don't pay a lot for it, and don't let your kid get a liberal arts degree. Let them do something that's a real science, a STEM degree. Okay, Patrick, are you disagreeing with me?
No, I mean, I agree with you in theory, Jason. At the same time, I look at, again, going to the logical way in which you approach everything in the emotional way. My kids I have two teenagers and a 6-year-old. And the teenagers, as much as I talk to them about school, about university, I mean, it's so embedded in our culture. Like I said before, there's a kind of a rite of passage.
Yeah.
And so ultimately for me, I want my kids to make their own decisions, right? I don't want to make decisions for them. And so, but it's up to me to create the environment in which they understand how to make the decision. So what I've done is, with just my kids in general, is I've tried to create an environment of accountability. And that's where, whether it's educating them about what you get as a result of going to school, a job, and then taxes, the type of job, the expense associated with school, because most people measure the expense and how much it costs, not what the opportunity cost is, because all of that money has an alternative use. And so the environment that Russell is talking about, there's a way in which you can do it that really allows you to be super efficient and leverage different resources, as well as create that environment of accountability so that the kids are involved, so that they capitalize on the opportunity. Because relationships for life are formed in university.
Sure.
A network is formed in university.
Yeah. A lot of drinking buddies.
Environment positions you for that, right? It's just one of those things where it's hard because there's no just distinct line, right, that delineates you should or you shouldn't. And that's where for my kids, I want them to make the best decision possible. And I have positioned them to hopefully be equipped with information, experience, so that they do that.
Yeah. Drew's on with us now, but one more thing to comment, it's not just the cost of college, it's the time. It takes that 4 years, which also represents an opportunity cost. Drew, what were you trying to say before, probably about California?
Well, about college, it's funny because one of my spit out my soup laughing moments of a Peter Schiff, quote was, Peter said that that government has made college extremely expensive and practically worthless.
Sadly true. Yeah.
And so, Jason, I'm the same way. I went to community college for 2 years. I loved it.
And then Cal State Fullerton.
I went to a state school, and it was, it's funny now because college has gotten so expensive that I went to just the local state school. It was nothing that special. It was like automatic enrollment from high school if you have above a 3.0, I think. And it was just oh, you're going there. Okay, that's just where everybody goes, who doesn't apply themselves. Now it's impossible to get into those schools because it's so expensive that it's oh, you got into there. It's cheap. Oh my gosh. Wow. You must be smart.
Right.
It's just so hard. It's the supply and demand, prices have skyrocketed.
They have. And let me introduce Drew, by the way. Drew is one of our investor clients. He has been investing with us for, I think, 10 years now or so. And Drew has a very successful business. His wife is an attorney, so she knows all about college and student loan debt. She works for the DA's office in Orange County, and Drew lives in Old Town Orange, California. So, and I've been trying to talk him and his wife, Katie, about getting out. I've been trying to talk them into moving out of the Socialist Republic of California. So just so you kind of know what's...
Well, we're loving it here, Jason. There's the police car in front of the high school every day. Our school, our local elementary school gets a 1 out of 10. I mean, what is there to... literally 1 out of 10.
Yeah, and how much is your house worth now? It's not cheap either.
Oh, it's over $1 million for sure.
Yeah, and so you pay over $1 million. You live close to Chapman University in Old Town Orange, which is a charming little area, by the way. But your school has a 1 out of 10, a terrible rating, and it's massively expensive. And now the state of California, the Socialist Republic, is implementing all these new tax proposals, which are just absurd.
Yeah,
it's
I don't.
Crazy.
I kind of have mixed feelings about the whole Prop 13 thing because it's kind of like low interest rates because I'm totally against the government charging you anything. So let me start there. But
yeah, you're very libertarian.
The idea that like the government is grandfathering these people in who are like doing all these things to like basically give the tax basis to their grandkids or something, and so like people are paying nothing in taxes. Like I think that's kind of one extreme, and then the other extreme is like trying to take everything, and so it's like to balance that, I think is the government going to mess that up? Of course.
Yeah.
So I don't know. I mean, it's sort of like low interest rates. It's just making the prices more expensive for everybody else. If the government charged a reasonable tax for these people who have grandfathered in at like some ridiculous low rate, then the prices would come down. So I kind of see it a little bit both ways, and they're not contributing their fair share. I mean, so I'm not saying that one way. I mean, it's like this rule had good intentions. It started out saying like, hey, if you're retired, if you're older, and you shouldn't be displaced from your home. But this shouldn't be your great grandkids get to pay $1,000 in property taxes 200 years from now. That's ridiculous.
200 years from now.
I mean, it's like it can't be either way. I don't know. I mean, and right now they're just proposing the commercial real estate stuff, which of course they're attacking businesses. And a lot of these small businesses, I mean, just to kind of play the other way, a lot of these small businesses, they have to have that tax rate to survive. It's like a lot of these restaurants, they would be totally dead if they had a high tax, if they were paying what the property that was worth. So
of course,
it's like, you're going to have that sort of unintended consequence. So anytime the government makes a rule either way to favor someone, or it's going to just blow back the other way.
Unintended consequences.
They pick winners and losers. And the thing we have to remember about all these, there are four basic terrible tax proposals on the table for the Socialist Republic of California right now. And it's the slippery slope, folks. They say, oh, well, this wealth tax is only going to apply to people with net worth above 10 million or 30 million, right? But it's a slippery slope. Trust me, that will come down and down. That'll suddenly be people with net worth over $1 million, which in California is nothing, by the way. Okay. Being a millionaire ain't no big deal anymore at all, folks. You got to be at least a decamillionaire, 10 million and above. Okay. So let's finish up on these questions. Okay. So here DM comes back and says, all right, so no crowdfunding, fine. But how hands-on on an ongoing basis would you have to be with out-of-state real estate through Jason Hartman Properties? I've got a life and a real job. Ha, yeah, I got it, DM. I understand. Well, through our network, we refer you to not only sellers and brokers, but also property managers. And so we make that job easy. And Drew is one of our rock star self-managers. So we also teach people how to self-manage their properties. And so he's real engaged with his properties now. He used to have managers, and that's a whole long story that has been on the podcast many times over the years and will continue to be. But we make that easy for you. It is hard if you don't know how to do it and you don't know who to do it with. That's what we do. And we've been doing that for upwards of 16 years now. So just reach out to us and let us help you and explain the process. And be sure you're listening to the podcast, my Creating Wealth podcast, and checking out our YouTube channel where you can learn a lot more. Okay, so that was that one. And SG is from New York. All right, get out of there as soon as you can. If you're talking about New York City. State, not so much, but city, yes. The state is still socialist like California, but at least you won't have the problems of New York City. Traverse City, Michigan. Steve, thanks for joining us. Okay, DM, thanks for the explanation on crowdfunding and the downfalls associated. So how hands-on?
Bounce. That's cool.
Yeah. Patrick, thanks for joining us. You've been on a long time. I'll talk with Drew. So thank you for coming on. Appreciate it.
Nice to meet you.
Okay, so DM says explanation about crowdfunding and out-of-state rentals. Well, I think I answered that question already, DM. Just reach out to us. It takes too long to answer that question. But listen to the podcast. Check out the YouTube channel. Lots more there. Russell says, yes, that's right. Thanks for all the questions back and forth, Russell. They've been great. Okay, so we already got that one. Russell says, oh, he's talking to Sarah in the thread. Okay, no problem there. This one, go to a programming boot camp. Oh, you're probably talking about universities or colleges, I think. Yes, that is a programming boot camp. Absolutely. Thought several people have gone side by side with software engineers. Yeah, absolutely. That's what I talked about, the internship. Go get an internship. Send your kid to get an internship so they can really learn the real world stuff. Okay.
Yeah, like if you're going to do like the STEM stuff where you're going to become an engineer or stuff like that, like obviously, a doctor, we're not talking about that. But most people who are going to like, oh, get a communications degree or something, it's like, okay, yes, like that, you're going to probably have much better luck, like sort of having a life experience, going out, maybe taking a couple classes,
right,
and going the cheaper path. You're not going to see that bigger results. I mean, and the other thing is like, the if you're getting into it, like I always joke that like if my son gets into Harvard, I'm paying for it. Like I don't care what it costs because like but if he gets into like the second rate school, no, like you have to either get into the what do they say, go to Yale or go to hell or something. Like
well, by the time your son Scotty is ready to go to Harvard, that whole model will have hopefully been disrupted and it'll be reasonably priced. Okay, hopefully we'll see.
Yeah.
Okay, so let's see some other questions here. It's not. Oh yeah. Nazik is saying, when I said $20,000 a year for college, it's 35,000. Hey, listen, I know it can be 50,000. I was just saying, like a reasonable college would be 20, but I guess.
Yeah, well, the other thing is, if you go to community college and you go to local state school, you're living at home, so it's cost of hosting someone in another state is going to be at least $2,000 a month. So it's like you can't blame all of that on the college. I mean, if you're going to go put someone up in another state, what do you expect?
Absolutely.
I say that college is sort of like a stay-at-home mom. Mm-hmm. It's like such a nice luxury, but like let's call it what it is. It's not something that's practical anymore. It's a luxury. So okay, like you're not entitled to it. So you can have whatever you want. You just got to pay for it.
Yeah, and a lot of these, I like the fact that the Trump administration has promoted some of these vocational school opportunities and things like that. Where did we get the idea that everybody needs to go to college? It's like that silly idea has been programmed into people by the
boomers.
Well, yeah, but also by the government student loan debt industrial complex. Okay, they're just promoting their own thing. Okay, Sergio Flores. Good morning, coming to you from California. Sergio, get out of that place. I'm a client of Jason for 10 years. Thank you, Sergio. We appreciate your business. Thoughts on rolling existing Roth IRA into self-directed IRAs to focus on rental properties? Great question. That's a complex question, but basically, I would definitely get your IRA to be self-directed. And Sergio, I'm not sure if you attended our Meet the Masters session that we just had, our first virtual Meet the Masters about a month ago now. But we had a segment on self-directed IRA investing and how to do it and how to make all that happen. I would definitely get it self-directed. However, the thing I want to say is that the self-directed IRA is not your first choice for real estate investing. The first choice for it is to use your non-qualified money, the money outside of your IRA for real estate investing, because you'll get better financing and better terms. And remember, income property is a tax-efficient vehicle. In fact, I always say it's the most tax-favored asset class in America. And the self-directed IRA is also tax favored, right? So you've got like a tax efficient vehicle inside a tax efficient vehicle. And that's okay. It's just that I'd rather get that tax benefit outside of my IRA. Okay. So I think the investing in real estate with your IRA is fine. I just would not do it first. I would first use money outside of your IRA to invest in real estate. And then when you've used all that money to invest, then come to your IRA as your next phase of investment. Okay.
Yeah, the other thing too is like this stuff is hard with compliance and everything. So you got to start with the easy stuff before you really start getting into this. I want to do this, this, and this with my taxes, because if you make a mistake, the penalties can be like crazy. So
yeah, but you can avoid the mistakes. I mean, but yeah, it's just not the first choice. Just
right. If you're a novice and you're doing this and you're ham-fisted about it as your first thing, it's you want to do that towards the end.
Yeah, good stuff. Okay, so great chat, guys. Thank you. Okay, Russell has been talking to us a lot through this chat. I agree, Jason. That's why we're using Patrick's. Oh yeah, we got that one already. Okay, I'm just going to get through these other questions here, Drew. Now, that's what I would call a real education plan. One rental property per semester. You like my idea. Drew, I don't know if you were on when I said this, but I said that for the cost of college, you could buy your kid one rental property every semester. And by the time they'd finish a 4-year college, they'd have 8 rental properties, right?
That's funny.
And you could have them manage it. And that would be great education for them. So, yeah, I don't know how we got off on talking about college so much. Recent podcast 1531 with Ross using Paradigm Life. Super powerful, but I didn't. Yeah. Oh boy, Andrew, this is another Andrew. That is a complex question, and I wish Patrick were still here for that one. So I'm going to defer that one to say talk with our investment counselors, and also have them, if you don't have Patrick's information, who was just on with us, have him get you in touch with Patrick's team to help you with that. That's just a super long, yeah, and you're just correcting a typo there. Okay. Yes, Bob is great. Hey, I'm glad, Irene, that you're using the asset protection and you went to the asset protection webinar, which is, again, jasonhartman.com/asset. Oh, and Russell is probably talking to you here, Drew. He went to Cal State San Bernardino for $1,500. See, now that's reasonable. Is that what you paid at Cal State Fullerton?
Yeah, that's what I paid.
Yeah, that's totally reasonable. SG, thank you, Jason. You are the best. Hey, thank you. We appreciate you engaging. Okay, Sacramento equals. Hey, we're not rated by the. We can use cuss words here. So Sacramento equals shithole city run by Mafia Pelosi and nephew Newsom. Hey, I don't disagree. I don't disagree with you. Yeah.
I think Newsom's going to be the president in like 2024 or something. I could totally see it.
Let's hope not.
I mean, he is slick. I mean, that guy. Both of them are political like masters at their game.
Yeah, they are good. They're good politicians. Yeah, unfortunately, because their economics are terrible. Yeah, awful. Okay, so shows other things. Dan, I don't know what you're referring to there, but okay, folks, I think we've gotten through all the questions. Drew, talk to us for a moment, and then we'll wrap it up. Thanks for coming on. We tried to get you on a couple weeks ago, and it's great to have you. So you want to share any of your real estate experiences or self-management or anything like that?
Well, it's funny. One of the properties I got rented. I own 2 homes that are in the same neighborhood.
And you've got 8 altogether, right? 8 investment properties, I think.
I think I have like more than a dozen, but I don't remember. Oh, okay. So something like that. I don't know.
I love that you don't know.
It sounds snooty, but I actually don't know.
Yeah. So you've got about a dozen properties now.
I think so. Well, and it's weird because like I count doors and duplex. I don't know. So, anyways, it's about. I have 8 in Indy. I think I have 8 in Indy. You're right. And so the folks that I had the house that was a nice house and I really liked the area. And then I ended up buying a house that was kind of a fixer upper, like 5 doors down, like 2 years later. Mm-hmm. And the prices have skyrocketed. The original place I bought was a 4-bedroom, 2.5 bath, and it rent for $1,650. This next place that's a few doors down that I fixed up real nice is a 3-bedroom, 2.5 bath, and it's renting for 1,800.
Wow.
So,
Yeah.
and that's in 2 years. And the first place I was talking about is all nice and everything. There's no problems with it. I think it would rent for more than 1,800 now. But what's funny is just the folks are actually moving from California to Indy. So I was telling my wife, I said, we'll have to pick their brain to see if we should move in after them.
Drew, last week I showed this map, and you can just see what's going on. This is just an example. It certainly only profiles a few cities, but there are many, many more, obviously. But you look at the migration out of these places, especially the high density areas, and into all these areas, right? And of course, it's true about many other areas around the country. That's just an example. But actually, I'll show one more slide there. People are voting with their feet, okay? And I thought you'd appreciate this sign. Yeah, pretty funny, huh? But Meredith Whitney, I had her on the podcast a few years back, and she wrote this great book called Fate of the States and the New Geography of American Prosperity. And it just shows you how the whole country, really the whole world, is just changing in terms of this radical redefinition of where people want to live, where the money is going, where the momentum is in terms of investing. So you're in two markets other than your California home where you live, but Indianapolis and Memphis. Drew, any thoughts you want to share about those markets?
Well, the Memphis one, I was afraid to switch over because it's a different type of tenant.
You're referring to self-management now.
Yes. Right? Yeah. So I exactly. I'm sorry.
And I was just talking generally, not necessarily about self-management, but just.
Okay. Yeah. Yeah. Well, I guess it's interesting because the thing that I kind of like about the self-management is you just deal with all different types of people, and you kind of have to have that engagement. And I have that with my business, so I think I'm suited for it. But I think for somebody who, it sort of stretches them in a way that they wouldn't normally interact with these type of people, these people from different walks of life. I mean, I'm dealing with an engineer from the phone company and somebody who works at Taco Bell. I mean, it's all over the map, and it just kind of cultures you. I don't know. And
these are your tenants you're talking about.
Yeah.
Right.
Yeah. So, but we don't have to make it about self-management. But yeah, I don't know. Well, tell me your situation. What do you think as far as you've been doing bigger deals now with these. You're working on a what is it? You're working on a couple big projects now.
Yeah. Well, I mean, I've done some bigger deals for my own portfolio, but the company is basically focused on single family homes, and I love my single family homes. I mean, I've got to start doing 1031 exchanges on a few more of them because they've appreciated so much. But I just wanted to put this up here to remind everybody, listen to the podcast, because a lot of the questions that you've been asking throughout the live stream the last 2 hours are discussed in depth on the podcast. And a lot of these are kind of complex questions. So I interview experts. Drew has been on the podcast many times. Patrick has been on, CPAs, lawyers, asset protection, et cetera, all discussed on the Creating Wealth podcast. So I really just want to make sure I say that before we wrap it up. But yeah, the market is super hot. Inventory is very low. Properties around the country in these markets, suburban markets where people are moving, are experiencing bidding wars. And there's just a lot of action, a lot of relocation of capital going on right now.
Yeah, I think that one thing that I would talk about that sort of is how I've evolved is, I started out sort of always looking at the pro forma, and there's an interesting thing about grading numismatic coins. People say never look at the holder that has the grade at the top. Always look at the coin itself. And because sometimes, over time the coin might have spots on it, or it might, have imperfections that come out after time. And so I think with me, originally I was always looking at the pro forma, seeing like, how can I do the best based on the lease that I have? And now I've kind of, and I think this is a consequence of sort of becoming a little more successful, having a little bit more capital, but I've sort of evolved out of, hey, instead of having a one home for $100,000 that I rent for $1,000 a month, I'd rather have a home for $220,000 that rents for $1,800 a month. And okay, on paper that may not look like, it looks like, oh, well, why would you do that? That's like you're losing 50% of your return. Well, when you back out the insurance and the hassle of having two tenants and the maintenance costs associated with the homes, I just think it's usually that $200,000 home is probably going to have more qualified tenants. It seems like a better experience. That's my opinion. I've sort of switched from being kind of a C+ type property to a sort of A- type properties.
Yeah.
And
you've done, Drew, what a lot of our investor clients do over the years. They kind of graduate, right? They start with these cheapo properties, and we certainly have those cheapo properties on our website, and then they upgrade. They own those for a few years. They realize, hey, maybe it would be nice to upgrade my tenant quality. And they'll sacrifice a little bit on the return. And just because there's people listening from all over the world or watching this, we even had a listener, a viewer in Bahrain. So all over, right? When we talk about the markets that we recommend, these inexpensive linear markets, you can buy $100,000 properties. You can even buy $60,000 properties. Those are obviously the lower grade properties. A $200,000 property in our network is a nice property. Okay. So that's, if you're listening from California and thinking $200,000, what are you talking about? You can't touch anything like that. So just understand it's relative to the market. But in Indianapolis, Memphis, Atlanta, many of our Florida markets, we have some really nice properties for $200,000 that'll give you a really nice grade of tenant. And by the way, I'll just mention this webinar we have going on right now. You can watch it right away. Just go and register and learn about the Southwest Florida market at jasonhartman.com/SW Florida. That's jasonhartman.com/SW Florida. And Drew, we got to get you into Florida a little bit. You don't have any Florida properties, and you haven't really spent any time here. I think you're going to be living here someday, like me.
Well, it's funny. I was looking yesterday at the best places to live that have the lowest taxes, and Jacksonville came up on the list, and I think Cheyenne, Wyoming, and I've never been to either one of those. I don't know if
Cheyenne, Wyoming is way too cold.
Yeah, I'm a weather wimp, so I think that's why I probably am leaning more towards Florida if I do make the rip the Band-Aid off. And I have family that lives there, but I just have I've only spent very small amounts of time. In fact, you and I were there for like 1 hour before we went to Puerto Rico or wherever we went.
Right. Which, by the way, we have a question on Puerto Rico here. We had a few more questions come in. What do you think about Puerto Rico, the real estate market in Puerto Rico? I have looked. I've been to Puerto Rico many times. I thought about moving there. Many of my friends live there. There's an incredible Puerto Rico tax deal, but I just don't like it. And I don't like the real estate market there. I've looked at properties there. The last time I was there, I looked around with a broker in two areas, one in the San Juan area, looking at some more city type properties. And they are expensive. There's a lot of money that's been flowing in there because of this extraordinary tax benefit that people get. But my friends that live in Puerto Rico right now are not happy. The lockdowns there are incredibly severe, and the crime rate is very high. I just don't like it. I don't recommend Puerto Rico. And believe me, I want to move to Puerto Rico to get that extraordinary tax deal. And by the way, there's information about this on my podcast. I've done some shows on this. It is pretty extraordinary. A lot of my friends have moved there for that. I have some very wealthy friends that live in Puerto Rico. Of course, Peter Schiff, who's been on the show, and Drew follows his work. He moved to Puerto Rico kind of famously. I just don't like the place that much. But yeah, That's my answer.
And I would say I'm no like Peter Schiff proponent. I mean, I think a lot of these talking heads, they're fun to listen to, but
yeah. But they're wrong,
you're gonna,
so often.
Yeah. I would say, you always say you're right about stuff, but you were right about that one.
Yeah. So this one, I don't know if I got your thing about the book or not. I'll check my Instagram. Appreciate that. Okay, and this will be the last question because it is 1:08 on the East Coast, and you know what? I eat lunch at noon, folks. I got to go make my salad that I make every day. And someday I think now that we're doing our stuff on Zoom, like at Meet the Masters, I was going to actually make a session at the lunch break where I show everybody my super salad because I make a great salad. See, I'm talented in real estate, but I also make a really good salad. So I got to go make my salad. I'm getting hungry here. So let's answer this question. We'll wrap it up. Interested in multifamily linear markets, self-managing from a distance. Any suggestions? Oh boy, I would have a lot of suggestions about that. And that's these complex things that take at least 20 minutes or a half hour to answer. Be careful of the multifamily. When you say multifamily, I'm not sure what size. If you're talking about a duplex or a triplex, that's one thing. If you're talking about an apartment building, it's quite another. Okay.
Yeah.
So just get in touch with our team, our investment counselors. They'll help you with all of this stuff through jasonhartman.com. And of course, check out the webinar that's on the screen. And yes, you think my salad's awesome. I love it. That's great.
I mean, my only thought about that is just, if you're going to do self-management, look at if you usually those properties are already under management. Look at the performance of the properties.
Yeah.
Pick the one that just seems like it's giving you the least hassle, the one with the least amount of problems, the least service requests, and just start with that one. And then, graduate, like you said. So, don't start. And that's what happened. I had a property that I'm like, this property, it's been an entire year. There's been no expenses. So I'm like,
right.
I'm going to start with that.
Yeah. Single family home is much easier to manage than an apartment because remember, on a multi-unit property, your tenants are talking to each other. Okay. And they can gang up on you and do rent strikes and all kinds of stuff. So a single family home really does have a very unique thing. And you just get really good quality tenants in single family homes usually. They're an upgrade from multifamily. Now, again, a duplex is kind of like a single family home.
Yeah.
But if you're talking, 20 units, 50 units, the biggest one I ever owned was 139 units. That's a whole different thing. That's a business. That's not a real estate investment. You're running a business. Yeah. So good stuff. Hey, Drew, thanks for popping on at the end here. And everybody, thanks for sticking with us for so long. I mean, this is the longest live stream yet, 2 hours and 12 minutes so far. So everybody, really appreciate you joining us every Sunday. We'll be back next Sunday. And occasionally we might surprise you and we'll jump on live during the week. But of course, the podcast, the webinars, check out this Southwest Florida webinar. I think you'll really enjoy this one. And we'll talk about some specific properties in a very desirable market right now, Southwest Florida. And Drew, again, thanks for joining us. Everybody, thanks for joining us. Until next time, happy investing, folks. We'll see you later. Bye-bye.